Good morning, Jerry.
Morning, Kim. How are you today?
Good, good. A little early for us, but I woke up in great anticipation on the topic that we're speaking about today, and I'm looking forward to it. Um, and we're gonna touch on the history of notes. I
Yeah.
think this is important to discuss because I can't tell you how often um, the regular people ask me, how can you do this, right? Are you licensed? Are you,
Hmm.
and, how did you get into this? And, where did this come from? I mean, 20 questions at once, right?
Yeah.
And I think that if we walk through the history of notes and how things have evolved and maybe even how we even got into it, it'll help answer some of these questions that, you
Yes.
know, the end investor has. And again, we're all about bringing about awareness and helping people grow comfortable with investing in notes. And so I think this is going to fall right in line with that. So I'm looking
Agree.
forward to today's topic. Um, and we'll share the information that we have with others. Before we get started, welcome to the Kim and Jerry podcast. I always seem to get halfway through our discussion before I say that. As well as, um, we're not financial advisors, we're not attorneys, and we're not CPAs. But this is for information and education purposes and, to grow the wisdom and the knowledge of note investing. So I'm going to let you get started. Of course, as usual, we join in and discuss, and I might have a few questions for you as well. So let's get started.
Hopefully, you have a lot of questions. You know, and
Yeah.
one of the things when we're talking about doing a podcast on the history of notes, I'm not sure how long it's going to last. It may turn out that we wind up doing more than one. This may turn into a little bit of a series, but we'll get started anyway. Um, yeah, as we've been investing in notes, I've had some similar conversations that you've had. It's like, well, what do you mean? What are you buy a mortgage? No, no, no. You go to the bank, you get a loan, and for a house, that's a mortgage. It's like, no, no, you can actually buy that mortgage, and it does sound a little counterintuitive. Um, so today, what I want to do is just kind of walk you through or walk our viewers through how did the note business start so that folks like us, First Shield Financial, could buy mortgage notes. And if you look at the note business in the United States, you really have to back up and just look at the mortgage business in the United States. And the mortgage business in the United States basically has three periods. There is the period of mortgages before 1934, from 1934 to 2008, and then 2008 forward to today. Um, and all of that has meaning to folks in Congress and the banking industry, but
Right,
for the average person on the street, it means nothing.
right, right,
So before 1938, excuse me, before 1934, um, only very rich people could buy real estate.
right.
That was true all over the United States. And frankly, it's still true in a lot of other countries. And I'll touch on that in a little bit. Um, so before 1938 to 1930, excuse me, I keep saying 38, in 1934, banks would only lend to buy real estate if you put at least 50% down.
Right.
And the term of the loan was 3 to 5 years. And then they expected the balance of what you owed to be paid.
Okay.
So obviously, folks couldn't buy houses, they couldn't buy real estate.
Right.
And as a result of that, only 1 in 10 people in the United States own their property, own their real estate. 90% of the citizens of the United States were renters. Contrast that to today, where almost 70% of the people in the country own their own homes. So, how did all of this happen? And this gets back to these periods and what was going on in those different periods. I did mention, that the pre 1934 time period. There are still countries in the world today that where the banks require 50% down.
Yeah.
A few years ago, I was looking at buying some property in South Africa, and the banks were saying, "Yeah, we can lend you the money, but you got to put 50% down." They're like, okay. But so this still goes on around the world today, and there's a reason for that. In 1934, the United States Congress, because we're in the middle of the Great Depression, decided to pass some laws to help the construction industry. At that time, there were about 2 million construction workers out of work because they couldn't build houses and they couldn't build whatever. And Congress said, well, gee, if we can make more money available, that can put all these people back to work.
Right.
So at that time, they founded the Federal Home, FHA.
Okay.
So that was founded then. And what that did is FHA put insurance in place so that the banks would be more comfortable lending money longer. So the reason the banks were not willing to lend money any longer than 5 years is they don't trust people. As most of you know, if you go to the bank, they don't trust you. They don't even trust you with your own money, but
Right.
they don't trust people.
That's another discussion.
Another discussion. No conspiracy theories here, but that's another discussion. But the banks didn't trust people, and the banks had to carry and foot any defaults on those loans. So FHA was put in place, and they put mortgage insurance in place.
Right.
And as a result, banks started to offer longer terms and better rates, that kind of thing. And the mortgages went up to 15 years. By doing all of that, that allowed, the banks, to keep the mortgage. The banks were keeping the money on their books for a longer duration.
Right.
And the other thing that happened at that time, the next thing that happened in 1938, Fannie Mae was established.
Mm-hmm.
And, you've heard the terms. Fannie Mae is the Federal National Mortgage Association.
Right.
Whatever.
We know it better as Fannie Mae.
We know it better as Fannie Mae.
Right.
And what Congress passed a law to put them in place, because what was happening, yes, the banks were now lending for longer periods of time, but they had these mortgages on their books. And if they have the mortgages on their books, they can't write any more loans.
Right.
So they solved one problem. They got the construction workers back to work, but then they were laid off again because the banks couldn't lend any more money.
Right.
So Fannie Mae was established to buy those mortgages from the banks. And by buying the mortgages from the banks, they gave the banks capital, which made them liquid again so they can make more mortgages.
Right. And you can see as each era was being developed that the whole thought was to bring about a synergy of an in and out process, if you will, for the banks, right?
Yeah.
They're heavily regulated, as we know, right?
Yeah.
And so they have to abide by these regulations. But sometimes those regulations put them in, stuck mode, right?
Yeah.
And so, Congress has a way of let's unstuck the system, if you will. And so,
I don't exactly give Congress that kind of credit, but yeah, not sure if unstuck is a good way to describe Congress. Congress looks like it's another story.
Okay. I was just trying to bring a little bit of levity to the whole thing, but the reality is that's the truth.
Yeah. So anyway, in 1938, Fannie Mae was established, and they started buying mortgages from banks. And net result is Fannie Mae now has all these mortgages, and they started selling those mortgages to other institutions. They sell them to insurance companies.
Mm-hmm.
All of us are familiar with annuities that you can get
Mm-hmm.
from an insurance company. An annuity and an insurance company is backed by a mortgage. So, the insurance companies figure out how many mortgages do I need to have, how much do they have to pay, when they're getting paid off, all this kind of stuff. And now I can write an annuity for Mrs. Jones for the next 30 years. And they're just taking the proceeds off of a mortgage that somebody's paying.
Right. Right.
So that was how this market worked. One other change that happened, again, to your point, folks were stuck. The other, I guess, I'm not quite sure why, but in 1948, Congress passed the rule that said you can make 30-year mortgages.
Right.
And, to this date, we have 30-year mortgages. And I guess, again, that was so that you can make housing available to more people because the payments could be lower, that kind of
Right.
thing.
Right.
So that's kind of, how this whole mortgage thing started. It's how the mortgage note business started. It was just a series of laws by Congress. There's another agency that you've heard about, Freddie Mac.
Right.
That was established in 1970, and that's the Federal Home Loan Mortgage Corporation. Now, Freddie Mac was set up so Fannie Mae was dealing with all these big banks. Freddie Mac was set up to deal with smaller banks. I think credit unions, places like that. And I know somebody's going to put a comment in the comment section that I missed some of the other things that Freddie Mac was set up for.
That's
but
good.
hey,
Yeah, we're listening. We get input. We get feedback.
yeah. So please comment on telling me more about what Freddie Mac.
Right.
Yeah. So because of all of this, the market for mortgage notes has been around forever, but it was closed. It was closed to the large institutions, the banks, the insurance companies, hedge funds, investment banks, people like that, extremely wealthy individuals, people like that, folks that wanted to have, if you were a bank, you're trading these things, you're trying to get the interest. Because frankly, on a mortgage, most of what people sign up for is interest. So all of these institutions wanted to be able to collect the interest, and that's why it was a very closed universe. Typically, when the mortgages were sold and the mortgages were traded, you didn't buy one mortgage. You bought 200. You bought 1,000. So you had to write checks for 10, 20, 50, 100, 200 $1 billion. Frankly, I can't write a check for $1 billion. But anyway, that's how folks participated in this market.
Right.
So you needed a lot of capital in order to be able to participate.
Right.
One other thing that I'll say, and then we'll get into what happened in 2008. When banks write mortgages, they've always assumed that the default rate, there will be a default rate. And going way back to before 1934, they assumed that there would be a default rate. And they price the default rate into the interest.
Mm-hmm.
So whatever interest they put on a mortgage, part of that money is going to pay for those loans at default.
Right.
They were set up to handle less than 5%. And they dial that into the interest. Then 2008 hit.
That's the period everybody knows, right? That's the period.
Everybody knows 2008.
Everybody knows when 2008 hit, right?
Yeah. Well, one of the things that happened in 2008 is that the default rate started to rise above the 5%.
Right.
By 2010, it had peaked at 10%. Actually, it was north of 10% at the peak. And what happened was all of these systems that Congress had put together, banks were able to, sell mortgages to Fannie Mae and Freddie Mac. they were inundated with defaulted loans,
Right.
and all of their systems were set up to be able to handle a maximum of 5%.
Right.
And frankly, it just hit the fan.
Right.
There were more bad loans than anybody could handle. And it's like, well, what do we do with all of this stuff?
Right.
How do we handle it? And so Fannie Mae, Freddie Mac, and all the banks started selling. They needed cash, so they started selling these loans to in smaller chunks, to other individuals, other entities, and that started kind of the note business. They started selling them to hedge funds,
Right.
and those hedge funds would say, "Well, gee, we only want mortgages for houses over 300,000 in Iowa." I'm not going to pick on Peoria and Wichita today. I'm going to pick on Iowa. So they only wanted mortgages in Iowa, and everything else they throw out. And they go to a smaller hedge fund that would take stuff in Wisconsin, or would take stuff for $100,000 or under 50,000, that kind of thing. And slowly but surely, they're starting to filter these mortgages out. And then there's some mortgages that are left over.
Right.
And somebody wants to sell them, and we raised our hand and
Right.
said, "Hey, we'll buy them," and they sold them to us. That's how this market started.
Right. Right. And
And
even stepping back a little bit, sometimes the sale from the bank to Fannie Mae and Freddie Mac are not large enough, right? But they're still heavy on the books at the banks. And so
yeah,
we also get direct mortgages from banks, right?
yes,
So, they're not as large as they would, sell to the larger institutions, if you will. But for
yeah,
us, as investors, this also continues to feed our ecosystem in regards to our investors who are interested in having notes in their portfolios.
absolutely. One of the other things that was also happening in this time period, excuse me, after this time period, was that the banks also started to cut back on the number of people that they have in their workout groups.
Mm-hmm.
So they don't have as many employees to work out defaulted loans. So essentially what's happened is you have this cottage industry
Right.
that we're a part of that's buying the loans. And we're buying loans that an institution doesn't want. And we have the infrastructure to be able to work with a borrower that's in distress, a borrower that has an issue, and a borrower that needs a rework or a workout plan.
Right.
Where the bigger banks don't want to do that, because the money in the mortgage business is in the interest. It's not in the back office processing.
Right. Right.
So the institutions, they don't want to do all of this stuff, so they farmed it out.
Right. Right. So, and whereby we have the flexibility to be able to do a whole lot more with the borrower than the banks or the bigger institutions can do.
Yeah. Yeah. So that's kind of the history of how did this business evolve. Excuse me.
I'm just going to step in. I feel you. This whole season of pollen, it's like snow. You can't get away from it, and you find
No,
yourself, I'm
no.
just grateful I'm not sneezing to death on the podcast. So
Yeah. I don't know what happened. All of a sudden, it just came up. So
no, I get it. I get
yeah.
it. So we're gonna have a season of pollen, and it is what it is.
And folks, 2 years from now, they're looking at the podcast. They'll know when this video was
Right,
done.
what season we're in.
Yeah. So anyway, going back to post 2008, that's why there were so many more mortgages available. That's why the entities like ours were founded, and like I said, I won't say a ton, but it's a cottage industry. There are a number of folks out here that are buying mortgages. Um, it's not a big industry because I think we know everybody in the industry. um, it's not small, but it's not huge.
Right.
It's a good size world. A couple of other things to throw into the mix. Again, post 2008, there are no rules on who can own the debt, and there never
Mhm.
have been any rules on who can own debt. So Congress never had that as an issue. Their issue was always liquidity
Right.
and making money available so that people can buy houses, they can buy, um, um, they can renovate their homes, that kind of thing. So that's what all these rules are for. But there are rules on the collection processes, and we have to follow those. Post 2008, there were a lot of rules from on the Consumer Financial Protection Board, things like that, and we follow those. The other final thing that I'll say is because this industry started with the liquidity crisis and banks throwing out loans that were in default, it opened up a new market for banks in order to be able to sell mortgages. So,
Yeah.
in addition to the defaulted mortgages, the banks are now also selling performing mortgages. So, where before they could only sell to Fannie or Freddie, or Fannie and Freddie could only sell to the banks and insurance companies, they're going back and forth. They now have this other conduit, which is entities like ours that buy their performing as well as their non-performing loans.
Right.
So as a result, we have increased the liquidity in the mortgage business. And I think ultimately, by increasing the liquidity, one of the things that Congress is trying to do, the Federal Reserve is trying to do, that liquidity lowers the overall cost of mortgages.
Right. Right.
And that's why you'll never see any rules on who owns the debt, because if you put those rules in place, interest rates go up.
Right. And the movement of the economy around mortgages slows up, right?
True.
And so, and we saw some of that not too long ago where, when they raised the interest rates, right?
Yeah.
We saw the shift in the marketplace. And while that shift slowed things down a little bit in regards to the banking industry or the larger institutions, um, we were thriving
Yeah.
during
Yeah.
that time,
Yeah.
because one, we had the flexibility, two, we could still keep the mortgages going, and three, we were able to work out the appropriate payment plans with the end borrower as well with the end investor, right?
Yeah.
So that didn't prohibit us from still being able to invest in mortgages. But what you do see with the banking industry and the whole mortgage industry when these interest rates, um, flux here and there, um, it changes the synergy of the ecosystem for mortgages, right? So,
True.
and so we play a vital role in the mortgage industry, um, being able to keep money going in and going out of the mortgage industry.
Agreed.
Yeah.
Cool.
This was good. I think that it might warrant another follow up to this. I think that there still might be some questions with now what? What does that look like? Because as you mentioned, there are no federal regulations around the ability to buy and sell notes, right? As
Yeah.
investors. Um, there are licensures that are required, maybe state from state, but there's only a handful of those. But when you implement the appropriate collaborations, it's still not a prohibiting uh, factor for us to be able to buy and sell notes in
Yeah.
any state, right? So this is a
True.
nationwide endeavor. And so we should probably take a moment to talk about that too, so that we can still continue to iron out any wrinkles of
Yeah,
concerns that
yeah,
they may be. But this is definitely a thriving, rewarding, lucrative, and dynamic way
sure,
of investing in mortgage notes.
absolutely.
Okay, as usual, do you have anything before I close out? Anything more you want to
Um,
say?
only if you like what you heard, hit like, subscribe to our YouTube channel to hear more about the note business. Um, as you can see, we're pretty excited about it. We
Yeah,
like what we're doing. We like to get more people involved in what we're doing.
yeah, yeah,
Um, so listen to some of the other podcasts, subscribe. That's
yeah.
and also if you want to find out more about us, go to our website, First Shield Finance, www.firstshieldfinancial.com.
Right. And you can actually schedule time with either of us from that website to talk about anything that you may have heard on this podcast or any of the other podcasts.
Yeah,
Um, and we welcome it. And
yeah,
because
and absolutely.
yeah, we're on a mission to at least bring about awareness, right, to the end investor. So, well, thank you for this. I hope you have a great day, Jerry.
All right. Thanks, Kim.
All right. Take care, everyone.